Welcome back to Investing Talk Podcast. It is Sunday, January 18th, 2026.
And today we are heading into, well, let's call it dangerous waters. We aren't looking at a cozy dividend aristocrat or the latest high-flying semiconductor chip maker. We are looking at the United States Natural Gas Fund, ticker symbol UNG.
As usual, before we start, subscribe, like, and comment to this video to support the show. We really appreciate the engagement. Now, UNG, I have to be honest, when I saw this on the schedule, my first instinct was to check if my portfolio insurance was paid up.
It definitely has a reputation, doesn't it?
That is putting it mildly. In the trading world, natural gas funds, and specifically this one, are often called widowmakers. It is an asset class known for absolute wealth destruction over the long term. If you hold this thing forever, you almost historically guarantee a loss. So, convince me, why are we talking about an asset that usually trends toward zero?
Because of the context. We are looking at a massive disconnect, a tension in the market that rarely happens. On one hand, you have a commodity tracker that has seen massive realized gains recently. We were talking about $93.3 million in realized trading gains just back in November 2025.
Hold on, let's pause there. 93.3 million. That is not a small number for a fund of this size.
It is massive. And yet, despite printing that kind of cash from its trading strategy, the fund itself is trading near its 52-week lows. It is beaten down, it is hated, and it is technically oversold.
So we have a fund that's making money on its trades, but the share price is in the basement. That's the mystery.
Exactly. And the solution to that mystery involves a confluence of events we haven't seen before. You've oversold technicals screaming for a bounce, and for the first time in years, a structural shift in the demand narrative involving AI data centers. It's the collision of an old-school, dirty commodity with a new-school tech driver.
Okay, buying a dinosaur because of artificial intelligence. That is a hook I can get behind, even if I'm skeptical. But before we get to the AI hype, we need to understand the mechanics of this beast. Because if we don't understand how it breaks, we can't understand how it makes money.
Let's get under the hood.
So let's unpack the financial structure. UNG is an ETF, not a corporation. They don't have a CEO selling iPhones or cloud subscriptions. So we can't look at revenue in the traditional sense. What are the vital signs?
You have to look at proxies for health. The two big ones here are net asset value, or NAV, and the trading performance. Basically, how well is the fund predicting and capturing the moves in the futures market? Because that's all they do. They trade futures.
Right. And you mentioned those eye-popping numbers from November 2025. Let's drill into those a bit more.
Sure. So in November 2025, UNG reported a net income of $74.4 million. But the number that really tells the story, the one that proves the concept, is the realized trading gains on commodity futures. That was the $93.3 million figure.
Just to clarify for everyone listening, because realized trading gains sounds like accounting jargon. This means they made the right bets on the direction of gas prices and they actually cashed them out. These aren't paper gains.
Precisely. It proves that the fund is currently positioned correctly to capture upside volatility. They aren't just sitting there passively losing money, they are actively capturing the swings in the market. That $93.3 million gain is proof that the engine is working.
Okay, the engine works, but let's talk about the size of the vehicle. Is this a small, risky pot of money, or is there real heft here?
It's significant. As of January 2026, the total net assets are sitting at $540.81 million. To give you a sense of value, the NAV per share back in November was $15.
And considering where we are trading now, which is significantly lower, that is a big delta. It implies a deep discount to recent value. But what about safety? If I put money into this, is it backed by actual natural gas sitting in a tank in Oklahoma somewhere?
No, and that is a common misconception. You don't own the gas molecules. The investments are backed by cash equivalents, and U.S. government obligations. Crucially, these government obligations have maturities of 2 years or less.
So, short-term treasuries.
Right.
That is about as safe as it gets for collateral.
Yeah.
You aren't worrying about the collateral going to zero unless the U.S. government collapses, in which case we have bigger problems than our gas trade.
Right. And the custody is held by the Bank of New York Mellon. This is institutional-grade custody. You aren't dealing with some FTX-style risk here. It's a regulated, transparent structure.
Now, I have to play devil's advocate. Why pay a management fee for this? Why can't an investor just go buy stock in a natural gas producer like EQT or Chesapeake Energy? Or, better yet, just open a futures account and trade the contracts themselves?
That's the competitive moat question. You can buy a gas producer, sure, but then you are taking on execution risk, management risk, debt risk, and regulatory risk of that specific company. If the CEO makes a bad acquisition, Your stock goes down even if gas prices go up.
Yeah.
UNG tracks the NYMEX Henry Hub natural gas futures contract. It is the purest way to get exposure to the price of the commodity itself.
And opening a futures account? Look, I've dabbled in a lot of things, but futures accounts are not for the faint of heart.
Exactly. It's high friction. You have margin calls, contract rolls, complicated tax reporting schedules. UNG offers the most liquid, transparent exposure without that friction. It democratizes access to the futures curve.
And you pay for that convenience. What's the ticket price?
The management fee is 0.60% for assets under $1 billion. Given the complexity of managing a futures portfolio, rolling those contracts every month, that's actually quite reasonable.
All right, so we know what it is, we know it made money in November, and we know it's safer than a crypto exchange. But the price chart, the price chart looks like a crime scene.
It looks rough, I admit.
So let's look at the tape. We are recording this on January 18th, 2026. What is the momentum actually telling us beneath the ugly surface?
This is where it gets really interesting. If you look closely, bullish short-term momentum is starting to fire. As of January 16, just a couple of days ago, UNG had advanced for 3 consecutive days.
3 green days in a row, a heartbeat.
Exactly, a pulse. And if you zoom out just a little bit, the fund is up 6.4% since October 15, 2025. So despite the drop we saw year-to-date in early January, the medium-term trend since October is actually a recovery trend. We are making higher lows.
And where are we trading right now?
The range is incredibly tight. We are bouncing between $10.07 and $10.37.
In technical analysis, we call that coiling. It usually implies a breakout is imminent. It's like a spring being compressed. But do we have any signal that suggests which way it breaks? Because a compressed spring can jump down just as easily as it jumps up.
We do have signals, and they point up. Look at the oscillators. The stochastic oscillator has been in the oversold zone for 6 straight days.
6 days is a long time to stay oversold. Usually you dip in and bounce out.
It is. Historically, when you see the stochastic pinned in oversold territory for that long, it is often associated with an imminent price bounce. It's like holding a beach ball underwater. You can hold it down for a while, but the pressure builds, and eventually it wants to pop up violently to the surface.
I like that analogy. And what about the RSI? That's usually my go-to for checking if a move is overextended.
The RSI is painting a similar picture. It is currently transitioning from oversold to neutral. Now, we ran the data on this specific transition for this fund. Historically, when UNG makes this specific RSI move climbing out of the basement, it shows a 69% probability of upside continuation.
A 69% probability is statistically significant. That's better than a coin flip by a wide margin. It suggests the sellers are exhausted.
Exactly. Everyone who wanted to sell has already sold. There's no one left to push the price down.
But is anyone actually buying? Is there liquidity or is it a ghost town?
Oh, it's active. It trades on the NYSE ARCA. You can trade as little as 1 share, and the increments are tight $0.01 spreads. But what's more telling is the options market. We are seeing active options trading, which implies institutional positioning.
Why does options activity matter here specifically?
Because smart money uses options to hedge or speculate on binary events. In the gas world, those events are the EIA storage reports and weather shifts. High options volume tells us that big players, hedge funds, commodity trading advisors are placing bets ahead of these catalysts. They aren't ignoring this asset, they're watching it like hawks.
Okay, so the technicals are flashing buy signals. The beach ball is underwater. But charts only tell you what is happening. They don't tell you why. We need to talk about the narrative. Why would natural gas, a commodity that everyone hates, suddenly become the belle of the ball?
Let's check the pulse of the market, because the sentiment data is shocking.
I pulled the data from AlphaVantage to get a quantitative read on the news flow. And I have to say, the numbers are surprisingly optimistic for something trading near lows.
What did you find?
The average bullish sentiment score is coming in at plus 0.226. In plain English, that's somewhat bullish. But the ratio is what surprised me. 80% of the major recent headlines, that's 4 out of 5, are bullish.
That is a stark contrast to the price action. Usually when price is low, news is bad. Here, price is low, but news is good. That's a divergence. And smart investors love divergences.
Exactly. So connect the data to the stories. What are these headlines actually saying? What is the why?
It boils down to 3 main catalysts. The first, and arguably the most exciting one, is AI power demand.
There it is. The AI angle. I've heard this theory floating around. Is it real, or is it just people trying to attach a buzzword to a boring commodity?
It's real physics. A high-conviction article from January 2, 2026, which had a sentiment score of plus 0.487, by the way, specifically links data center build-outs to surging power needs. Think about it. AI data centers aren't just big computers, they're energy hogs. They run 24/7 and they run hot. They need massive amounts of cooling and massive amounts of electricity.
And renewables can't cut it.
Renewables like wind and solar are intermittent. The sun doesn't shine at night, and the wind doesn't always blow.
Yeah.
Data centers need baseload, power-steady, reliable, dispatchable power. Natural gas is the most reliable bridge fuel to provide that.
So the thesis is that the tech giants, the Googles, the Microsofts, are going to need massive amounts of baseload power, and gas is the only thing that scales fast enough.
Precisely.
Yeah.
It benefits gas prices structurally. It puts a floor under the demand that wasn't there 5 years ago.
Okay, I'll buy that for the long term. What about the other catalysts?
Catalyst number 2, LNG expansion. Liquefied natural gas. We are seeing global capacity increases and a continued shift in European policy. They are phasing out Russian gas completely. That is a geopolitical shift. If Europe needs gas and they aren't buying from Russia, they are buying it from the U.S. via LNG.
That puts a geopolitical floor under the price. And the third catalyst.
Good old-fashioned weather and storage. Traders are eyeing early January weather forecasts and storage tightness. The markets are nervous about a cold snap. If the polar vortex dips down, demand skyrockets overnight.
I want to push back on the institutional positioning for a second. I saw the flow data for November 2025. There were $183.1 million in withdrawals from the fund. That looks like people running for the exits to me.
I saw that too. But you have to look at the context. Remember those realized gains we talked about?
Right.
The $93.3 million?
Right.
Those withdrawals occurred during that exact period of huge realized gains. This suggests it wasn't panic selling. It was profit-taking by authorized purchasers, or APs. These are the market makers. They rode the volatility spike, made their money, and took chips off the table. That is healthy market behavior, not a sign of a broken fund.
Okay, that's a fair counterpoint. Profit-taking is different from capitulation. But look, we cannot just paint a rosy picture here. I started this show by calling it the widowmaker. We have to look at the risks because they are nasty.
The bear case. We have to go there.
The biggest risk, the one that guarantees long-term losses in this fund, is contango decay. It is structural. It is the silent killer.
Okay.
Listeners, let me put this in perspective. If you had invested $10,000 in UNG at its inception, do you know what it would be worth today? About $70.
That is a staggering statistic. That is 99% wealth evaporation.
Exactly. And it's due to contango. Can you explain what that actually is in simple terms? Why does the math hate us?
Sure. UNG doesn't buy gas. It buys futures contracts. Those contracts expire every month. So at the end of the month, they have to sell the expiring contract and buy the next month's contract.
Okay.
Now, normally the market expects prices to be higher in the future. That market condition is called contango. So the next month's contract is more expensive than the current one. Let's say the current contract is $3 and next to this is $3.10. You sell at $3, buy at $3.10. You get fewer shares. You are constantly selling low and buying high just to maintain your position. That roll cost is like a monthly subscription fee that eats your value over time.
So why would we ever touch this if the math is rigged against us?
Because that is a buy and hold problem. My rebuttal is that this thesis is not a buy and hold for 10 years retirement play. This is a swing trade. We are talking weeks or months. And crucially, if the structural shifts like LNG and AI demand happen, they might flatten that futures curve. If demand spikes now, spot prices go up and the curve can flip, removing that drag.
Okay, so it's a tactical tool, not a marriage. You date UNG, you don't marry it.
Exactly.
But what about the immediate risk, the weather? I saw news on December 31st, 2025, that February futures settled below $4.
Yes, that was a bearish signal.
If we get a warm winter, if everyone is wearing t-shirts in February, heating demand collapses. That destroys the price. Meteorologists are notoriously bad at predicting 3 weeks out, let alone 3 months.
That is the immediate threat. A warmer than expected winter is kryptonite for this trade. However, my rebuttal is looking at the technicals. Remember the oversold signal?
The 6 days in the stochastic basement?
Exactly. That tells me the market has already priced in a lot of this fear. The price is beaten down because everyone fears the warm winter. This is a classic buy-on-weakness setup. You want to buy when the fear is already in the price, not when everyone is euphoric.
There is one more risk I want to highlight, the speculative nature of the AI narrative. While the AI data center thesis makes sense logically, I have looked at the SEC filings. UNG doesn't explicitly quantify its exposure to this. It's a narrative trade, isn't it?
It is. You are betting on a macro correlation that hasn't fully proven itself in the data yet. It's a macro bet, not a line item in their accounting. You have to be comfortable with that ambiguity.
All right. We've looked at the money, the charts, the feelings, and the fears. We've looked at the widowmaker in the eye. It's time to make a call. Let's head to the verdict.
Let's do it.
So you've crunched the numbers. What is your bullish score for UNG right now?
I am signing a bullish score of 7.5 out of 10.
7.5. That is high confidence, but not maximum confidence. Walk us through the elevator pitch.
The thesis is simple. UNG is a tactical swing trade into spring. We are looking at a 3 to 6 month horizon.
And the drivers?
It's a trifecta. You have oversold technicals. That 6-day stochastic signal is screaming value. You have positive trading results. That $93.3 million in realized gains proves the engine works. And you have macro catalysts, the AI power demand and LNG export floor providing a structural bid.
So what is the strategy? If a listener wants to execute this, what are the parameters?
The target horizon is through Q1 2026. You want to be in the trade to capture the winter demand peaks.
And when do we get out? We need a number.
You need a disciplined exit strategy. I am looking to take profits on rallies above $12.50.
$12.50. Why that number?
That was the NAV level back in November 2025. It's a proven valuation level that acts as a magnet. If we get back there, take the money and run. Don't get greedy.
And if we are wrong, if winter is hot and AI turns out to be a dud...
Stop loss below $9.50. That is the technical support floor. If it breaks $9.50, the thesis is broken, and you cut your losses immediately.
So upside to $12.50, downside protection at $9.50. That's a solid risk-reward ratio.
It's an asymmetric bet, and that's what we look for.
So what does this all mean for you listening right now? It means UNG is a high-confidence trade at a 7.5 out of 10 based on hard data. But, and this is a big but, it requires active management. You cannot buy this and forget it. You have to watch the weather, watch the charts, and respect the volatility of natural gas.
Ideally, knowledge is most valuable when understood and applied. And here, applying it means being disciplined.
Well said. That wraps up our look at UNG. As always, thank you for listening. If you got value out of this deep look, please subscribe, like, and comment to this video to support the channel. We read every comment, and it helps us choose the next topic.
Thanks for tuning in. Stay curious.
See you next time.